The main factors that are contributing to this global economic slowdown are, for one, the war. Second, you have energy prices, you have a food shortage, and not to mention inflation. All these different factors coming together are impacting countries in Europe. It's impacting countries in Asia. It's impacting us here in the United States, where the economy is slowing, but still nobody wants to admit that we're entering a recession. Let me actually read you this one sentence from a Bloomberg Instagram post that's titled, "The European way of life isn't looking too sweet." And what it says is that a multi-year shock to living standards looms large across countries such as Spain, Italy, France, and especially Germany, as real wages fall faster than their counterparts in the United States, where life will look sweeter. Europeans will have to contend with less energy, less output, less disposable income, more inflation, and higher import costs. Social unrest is a real risk. That's a not so pretty picture for a number of different European countries that are saying that what we're having here in the United States looks very sweet compared to what's happening in those countries. But if you dissect what's happening in the American economy, that doesn't look very sweet either, which gets you more concerned about what's happening in the global economy. But there's a few factors that I want to focus on today. I want to start by talking about the UK economic slowdown and how this will directly impact us here in the United States. Second, I want to talk about the Chinese economic slowdown. And third, I want to talk about the dollar and this global currency crisis that we have going on right now. First, let me talk about the UK. So the British economy was facing some of the highest inflation that they have seen in decades, kind of like what we saw happen here in the United States. And people were moving away from the pound, which is their currency, into other currencies like the dollar. That's why we saw the pound lose value relative to the dollar. We had these big investment institutions in the UK, like pension funds, that were investing into things like their own government bonds. And so they would invest their money into these government bonds and then get interest on these government bonds, which then they would then pay out to their pension holders. Now, if you invest your money into a pension, you are looking for a consistent stream of income when you start receiving your pension. And the way that the pension funds would give out these pensions, they would invest their money into these government bonds, which are very safe, which paid good interest rates, and then you never really had to worry about it because the pension funds always paid. Well, in 2020, when the pandemic hit, the Bank of England, their central bank, kind of like the Federal Reserve Bank, cut interest rates to near zero. And so when they cut interest rates, the interest rates that pension funds started to get also dropped. This didn't just happen in 2020, this has been happening for a number of years, but the interest rates now that pension funds were getting was dropping, so they were struggling to continue to pay their pension payments. So what did the pension funds do? Well, they used this opportunity of low interest rates to go out and borrow money to buy more government bonds. That way now you can borrow money cheap and buy more government bonds that are paying interest, kind of like arbitrage. That way now you have more money coming in to pay off your pension holders. And this is what's been happening in places like Britain. We have the same thing happening here in the United States. But what happened in the UK then was the pound started to fall and the bonds started to drop. They had a new prime minister come in who changed their policies. People got worried about more inflation coming to the UK, so they started selling off their bonds. Bond prices started to collapse. And now you had these huge pension funds, these huge investment firms that not only own a ton of bonds, but are completely leveraged up to buy more bonds, which were supposed to be the safest investment in the world. That way they can continue making their pension payments. People's retirements are hanging on the threads of these pension funds. And now these pension funds are getting hit with margin calls, collateral calls, saying that your debt, your payments are due because your investment is falling. The underlying value of your asset is falling, so you need to make a payment. Now these pension funds and investment funds said, we don't have all the cash to make these margin calls. And if they don't make the margin calls, then they go bust. They lose everything. So they started to sell even more of their bonds now to have cash. So they're liquidating their investments to have cash to make their margin call payments, all while they're risking the citizens' retirement accounts, the citizens' investment accounts. And this is where you started to see an even bigger drop in bond prices, into the pound prices. And that was where just recently you saw the Bank of England open up their money printer and say that they would now bail out the bond market. And they started printing more pounds, printing more currency in order to buy more pounds, in order to save their currency, in order to save their bond market, in order to save the pension funds, which they did. Now the pension funds saw their bond prices rise and they were okay. They didn't have to worry about their margin calls, but you were fueling one bigger bubble, because now when you print more money, that creates more inflation at a time where inflation is already near record highs. So you got to understand the dynamics of what's happening, because now the UK economy is really struggling, because now not only do you have this bond market collapse happen, you have the whole economy that's starting to struggle more, you have all the inflation issues, and it doesn't look like it's going to go away because the central bank doesn't want to see the pain that would come from these types of failures. And it only took one thing to cause the entire bond market to essentially almost collapse. Now you have to think, what if something like that happened here in the United States? Because we have similar issues. We have pension funds and institutions that are leveraged up to their eyeballs that are relying on things like government debts in order to survive. If we were to see something similar happen here, what would the Federal Reserve Bank do? Would they bail out the markets and cause more inflation? Or would they let them fail? Now, letting them fail has consequences. People lose money, investment firms lose money, people lose their jobs. However, if you don't let them fail, you cause more inflation. You build a bigger bubble. It causes more problems, which means that eventually, when the bubble ultimately has to bust, because you can't just inflate the bubble up forever, when the currency ultimately no longer has value, that pain then will be even more painful. And this is where the Federal Reserve Bank has to make that distinction, and we have to see what will happen, because it only takes one thing to trigger the dominoes to fall, especially when you've been in this low interest rate environment for so long, like we have been here in the United States. We've been in a near 0% interest rate environment since after the 2008 crash. So our economy has been super reliant on low mortgage rates, low interest rates, low cheap debt. And now for the first time in 2022, we are skyrocketing our interest rates at very fast rates. And now we have seen mortgage rates rise, we've seen interest rates rise, and now all these companies and institutions that have been relying on and banking on these super low interest rates are gonna see a shock when the effects of these higher interest rates trickle down the market. And if one thing starts to fall, it could trigger many more dominoes. And this is where the question is the Federal Reserve Bank going to let the economy correct, like they say they're going to do, or are they going to give in and produce more inflation, which will ultimately make the bubble bigger? And so this is why you have to pay attention to what's going on in the UK, because this could foreshadow what could happen in the United States, because it took one thing to trigger the whole bond market to collapse, essentially, until their Bank of England went in and bailed them out. But that's going to come with consequences as well. As we all know, inflation is a price that regular people have to pay. Now, we did cover this entire story in Market Briefs, which is my free financial newsletter. If you have not joined Market Briefs yet, and you are an investor, especially in this economic environment, you need to be aware of what's happening in the markets around you, and Market Briefs does that into a fun, easy to read and witty email that you can read in less than 5 minutes every morning. And the best part is that it's completely free. I created it as a resource to help you stay up to date on what's happening. That way you can make smart decisions with your money, and it's a really fun newsletter. I promise you, you're going to love reading Market Briefs every morning. So if you want to join Market Briefs for free, I'll put the link to how you can do it down in the description below. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide that goes over what passive income is, how to start generating passive income. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.